Good afternoon, everyone. Welcome to this update for global stocks for the 6th of August. This is going to be a quick video. I've got limited time this weekend as I'm heading to the Gold Coast for the Investors Association conference. There was quite a big surge in stocks on Friday night, some very strong US jobs data, and that did put a bit of pressure on precious metals, but look, it was still a pretty good week all around for stocks in general, and also for the precious metal stocks. So let's have a look at the summary of last week. The S&P ended up putting on 9 points, and all of that and some occurred on Friday night with really quite a strong rally to a new all-time high. So that came on the back of some very strong jobs data, and if you remember back, we had an incredibly weak reading in May, and then that was followed up by a reversal of that weakness in June, and then of course another strong set of data above expectations last night. So it looks like the May figure was just a bit of a rogue number, and so that put the prospect of the Fed raising interest rates back on the table. And interestingly, or even amazingly, the market actually took that as a positive. And as you know, for the last 5 or 6 years, whenever there was any suggestion at all of economic strength, which could see the Fed raise interest rates, the market basically fell over. We even saw that back in December when the Fed raised rates. The markets fell over in January and then again in February. So really quite a different reaction this time. Perhaps it's a sign that people are really concerned about the negative interest rates and the ultra low interest rates, and are now actually seeing rising rates as a positive. Now, technology and healthcare stocks are still leading the way. They're the strongest sectors over the last 4 weeks since the Brexit outcome. So renewed strength there. And of course, the US dollar rose after the Bank of England made a decision to cut their interest rates from 0.5% to 1/4, and also came out with a lot of stimulus to buy government bonds and also to buy some corporate bonds. So that caused the British pound to fall. The US dollar went up, and then of course Friday night capped it off with the expectation that the Fed now may move ahead on rates, and so that added a bit more to the US dollar. All this good news caused the VIX index to decline down into the 10s, which is just an amazingly low level, and it won't stay that way. I can absolutely promise you that it will not stay with these quiet conditions with the VIX around the 10 mark. There will be a volatility breakout at some point, because it's just not sustainable down here. Now, the other good news is that the NASDAQ index also confirmed the new up leg in the S&P, as we'll see on the charts. And so really everything is just lining up. There's no denying that this is a new leg higher after 2 years of consolidation. The Aussie dollar, the RBA must be tearing their hair out, honestly. We cut interest rates on Tuesday to 1.5. The RBA minutes that came out on Friday strongly hinted at two further rate cuts, whether they're this year or next year, but it indicated that the RBA certainly has their eye on a cash rate of down at 1.0%, and yet the Aussie dollar went up against that. So the RBA must be absolutely despairing about what they can do, and if the Australian dollar stays between 75 and 80, then that's going to make it that much tougher for our economy. Now, the ASX 200 index reversed the gains from the previous week and finished down by 65 points, but we'll obviously see a gain on Monday, and we could even see all of that reversed again on Monday. So let's take a look at some charts. So we'll start with the S&P first of all. Let's just pan back and take a big picture grab. So there's our big surge from 2011. We then peaked out in April of 2015, or probably a little bit earlier actually, and started in this big sideways consolidation. And there was the possibility that we could have been breaking down and I guess we did break down very temporarily here in January and in February, but it was really the Fed stepping in, the Bank of China stepping in with stimulus, the ECB ramping up stimulus even further, and all of that just completely swamped out any selling in the equities market. And we've now got a situation, whether you like it or not, that the equities market is really the only game in town. There's just nowhere else to go for a lot of investors. So that's what's really lifting this now. So we've broken clearly above it. If we were going to, if this was going to be a false break, we would have seen a retracement by now. You can see we just hung there for around 2 weeks around this 2160, 2170 level, and then quite a strong surge on Friday night. So we're definitely off again there now. Let's just look at the NASDAQ. So there's the NASDAQ also surging quite a lot. It's gone from 4,200 to 4,800 since we saw the lows at the end of June. So very, very positive around the US market. Looking at the VIX index, you can see we're just continuing to play around this 10 to 11 mark. And if we pan right back, you can see that these are pretty much the all-time lows down here around 9. So we're very, very close to the all-time lows. And it's pretty hard to justify the VIX being at this level given what's going on around the world, particularly with the banking crisis in Europe. And I don't use that term lightly. There really is a crisis in Italian banking. And as I've pointed out many times before, you just got to look at the chart of a stock like Deutsche Bank that's lost 90% of its value since 2007 to know that all is not well in the European banking system. So pretty unusual to see the VIX down at this level. Turning now to precious metals, gold was down by $16. Again, all of that on Friday night. Silver slipped under $20. That was due to the US dollar rising. And interestingly, the gold and silver stocks finished neutral on the week. They went up in the first part of the week and then they fell back on Thursday and Friday. But they all finished, or the vast majority of them finished well off their lows. Some of them finished actually on their highs of the session. They gapped down, but then turned around. So the buying support just keeps coming in to the stocks all the time. And they're really showing great resilience against the Friday selling. So looking at the next 5 months, because we've now got seasonality with us, seasonality really should be a tailwind. However, June and July should have been negative and they weren't. So we've had a major gain during a time of year when you would expect to see a decline. So seasonality doesn't always work. However, there's a real fundamental seasonality about August and September, and that seasonality is is to do with the physical buying in Asia. So there is a tailwind, certainly, that should support the price of gold. However, we still have this overhang in the speculative futures market. That remains a danger. But I think when I weigh it all up, the possibility of some dips is still there, but I think they are probably going to be relatively short in dimension and fairly brief in time. So I just think the prudent positioning at the moment is to have a good, healthy exposure to precious metals, but don't be all in. Have some cash up your sleeve and expect some sort of pullback at some stage. But we're certainly into a very powerful part of the year's seasonality, as we'll see. I've got a chart on that in just a minute. In fact, we'll go and look at that right now. So starting with, let's just look at the ASX 200. So there we had a sell-off on Tuesday and Wednesday. We partially reversed that, but I would expect we're probably going to trade up close to 5,600 on Monday. Now, this is silver. So silver has continued to hold above this key support level. did get some selling, but really currency related selling. This is gold on a daily basis, so still in medium term uptrend. And if we look at the weekly chart, you can see quite clearly there we've got still a very, very good uptrend in place. Let's just look at the GDX index. There we go. We had a little bit of a gap down, so we had higher throughout the week. A little bit of a gap down on Friday, but look, not much. Really, it wasn't much of a sell-off considering the fact that gold fell about $25 an ounce on the session. That's really a pretty mild reaction to such a decent move in the gold stock price. Now let's just look at the seasonality, and I'm going to use Barrick Gold as an example. So what you're looking at here is the average monthly performance over the last 20 years for Barrick Gold, so 1996 to 2016. And you can see that clearly the three strongest months of the year are August, September, and November, with some decent selling in July and also in October and also in March. Now, we didn't see selling in March because the bull market was really just getting underway, so that's reasonable. The fact that we didn't get the normal selling that we would get in July is a really positive sign. And I guess we just need to be aware that there might be some selling at some stage between now and the end of the year, but certainly with the three strongest months of the year coming in the next four, you can see there's certainly a good seasonality advantage there. Other commodities, copper was down to 216. That was with the higher US dollar. Crude oil was steady at 41.60 and is certainly back into bear market territory now. There's the spot copper chart just coming off a little bit as the US dollar went up. So to wrap it up, general equities clearly trending higher in the US. Australia not so much, but doing better than they were. But certainly the Australian market is underperforming the US market and much of the rest of the world. We've now got multiple confirmations of the new upleg in the S&P. We've got obviously the NASDAQ setting new all-time highs is confirmation. We've got a move out of bonds. So there's clearly selling in bonds now. And so people are coming out of bonds and going into equities. So there's a number of things that are confirming the trend, both fundamentally and technically. Precious metals, we've got powerful seasonality in our favour. However, we've still got this futures overhang. So we've got this tussle between those two different forces. And I think it's really just a question of whether a trigger emerges that are going to scare the highly leveraged futures players, because they are so highly leveraged, and we're talking 20 to 25 times leverage. They cannot afford to sit around through a 5 or 10% correction in gold. It would wipe them out. So they're going to react to any little move down in the gold price. So it's really just a matter of whether any triggers come along to scare them, and if they do get scared, then how much of the investment buying is going to be able to oppose that selling pressure. So that's really the question at the moment. Now, as I mentioned last weekend, I'm speaking at the Investors Conference next week, and I'll be on the Gold Coast from August and available to catch up with anybody from August 8 to 10. My schedule is getting reasonably full now, so if you did want to catch up with me, then please let's make an appointment. And what I'm proposing is that I can offer you independent and unbiased perspective on what's going on in the market, and I think you might find that helpful. So there's my contact details for non-members, and we'll look forward to seeing what happens, particularly with precious metals next week. That's it. Cheers.